Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder back with another episode of ETF Spotlight. Now, this week we are joined by Paisley Nardini. She is the managing director and head of multi-asset solutions over at Simplify. And we're diving into the CTA ETF today. I know, brief abbreviation, but we're going to dive deeper into it today with Paisley. So thank you so much, Paisley, for taking the time. We have so many questions. I mean, specifically, CTA is structured to deliver uncorrelated returns across futures, commodities, and long-short portfolio, correct? So if you wouldn't mind, just maybe walk us through how this specific fund was created and how it operates that investors need to know about.
Yeah, well, first and foremost, Dan, thanks for having me, and thanks to Seeking Alpha for highlighting our managed future strategy, which we're super excited about, I think, for the reasons you already mentioned. Low correlation to traditional stocks and bonds, and I think this is a growing part of the market that advisor portfolios are seeking to add, just given, volatility in bonds and high valuations in equities. How can they hedge their portfolio, diversify their portfolios? So as it relates to CTA, which is the ticker for our simplified managed future strategy, how did this come to be? So let's back up about 3.5 years when CTA launched in March of 2022. And for anyone who's listening, who's in the managed future space, we know that 2022 was a strong year for the strategies because of the volatility that we experienced in stocks and bonds. So really great time to come out of the gate. But as it relates to our strategy in particular, I think it's important for everyone to know that CTA was born out of a partnership between Simplify Asset Management and Altus Partners. So rather than being a homegrown strategy, Simplify really recognized the longstanding history that Altus Partners had in the institutional managed futures space. They've been around since the early 2000s. And so we sought them out to really bring this institutional hedge fund process and strategy to market in a liquid ETF. We'll talk about some of the differences of our strategy versus some of our peers. But I think it's important also to recognize that CTA is entirely rules-based, meaning there's no manager discretion or fundamental kind of overriding. We're utilizing an institutional algorithm to drive daily positioning. And despite this, though, both Altus Partners and Simplify is continually evaluating the strategy for enhancements. So we do have that active oversight behind the scenes as well.
Now, Paisley, can you walk us through how this institutional model might set up the process for identifying trends that this ETF might follow?
Yeah, so Altus Partners has a fairly robust algorithm that drives the daily positioning. So it's Altus Partners with developing of the signals, and then they're feeding those signals and those positions to Simplify, who's doing the trading, execution, and portfolio management. And so the model behind this at its core is trend following. I think that's really important to recognize. Managed future strategies aren't always trend following. This strategy in particular is, but we have some additional signals or indicators that have been incorporated to help build out a more robust signal. And I think the importance of this is that, one of the common pitfalls of trend following is that trend is your friend until the end, as they say. And by the end, we mean when those trends shift direction. And so the signals in CTA are looking at things beyond just price trend. They're looking at some fundamental macro factors. They're looking at the shape of the yield curve, which is really important for our interest rate positioning, in addition to just some broader kind of covariance movements between various, stocks and bonds to inform our position within the fund. So at its core, trend following, but then kind of ancillary positioning or indicators around that to help provide a more robust signal.
Can you offer any sort of look into the side of things of how it knows when to go risk off? I mean, this is a question that comes up across a couple of our episodes of we're always listening about systematic approaches, and we're like, well, how does it know when to go risk on, or how does it know when to go risk off, and how does it make that switch, whether it's on a daily rebalance, weekly rebalance, monthly rebalance, or whatever it might do?
Yeah, great question. The reason it is such a great question is because trend following in an unconstrained approach, which is how we think about taking risk, is very flexible. It's very dynamic. And I think that's really important when you think about having this, diversified part of your portfolio, is that risk can be really advantageous, meaning you can get rewarded for taking risk. And then vice versa, risk can be a huge performance headwind. And so the way that we've constructed CTA is in an unconstrained fashion, meaning we don't want to have to take on positioning, or as we see it, risk, if our signal is not showing edge, or otherwise said, we don't think we'll be rewarded for taking that risk. And so how do we think about this? Well, first and foremost, our overall volatility of this fund, we're not volatility targeting, which many strategies beyond even diversifiers in a portfolio might have a volatility target. We might scale anywhere from high single digits in an annualized volatility all the way up to, say, 20, 25, even 30% annualized vol. And this will be at points in time. And so a prime example of this kind of risk off ability in this fund is when we have extreme dislocations in the markets, like we did earlier in 2025 with the tariff tantrum. When all of a sudden markets are falling apart and we're not seeing signal in the edge from a trend following perspective, we can scale down volatility commensurate with that. And so in addition to the ability to be dynamic and how and when we're taking risk in the portfolio, we also have some indicators that we're assessing that give us kind of a risk off tone in the marketplace. And that's really looking at the correlation or the movement of stocks and bonds. And so when equities are moving higher, we would see that as a risk on environment. That might inform our interest rate positioning, meaning we wouldn't want to take on that risk off, bond position in portfolio, and vice versa. As we saw earlier in 2025 in February, March, our model was picking up a risk off tone just given the direction of equity. So we kind of have that first layer of taking risk, and then the second layer of how we're thinking about our interest rate positioning as a result of equity movements.
What should investors out here considering CTF or CTA to put in their portfolio, for the investor that's considering it, when they think about futures and how it's inherently, it's a leveraged product, right? You're taking a value and you're magnifying it, and they might think, well, that's risk. That's going to increase the vol as you're expecting a whipsaws back and forth potentially. What should they know about how your fund might help mitigate those swings over the long run? Is it through the diversification of all the different buckets that balances out over time, or is it, another mechanism that might be in the background?
Yeah, so kind of going back to my earlier comment in that we have a very unconstrained approach to how we take risk. I say that as a benefit. It's a feature rather than a bug of this strategy. With that being said, the way that we control for the inherent leverage of this strategy, again, futures, as you mentioned, have inherent leverage embedded within them, is that each contract that we're investing in requires margin to be posted as collateral, and that's in the form of treasury bills. So high quality underlying collateral that's being used in this strategy. And the way that we think about kind of capping the leverage that we can take, or the overall exposure that we can achieve through our futures positions, is by instituting a 25% margin to equity cap. What does this mean? The underlying margin that's posted, the sum of that cannot exceed 25% of the total NAV of the fund or the market value. And just for reference, even though there is that 25% cap, we're typically about 10 to 13% cap. Currently, we're about 10% margin to equity. So by no means are we kind of pushing that upper limit or that ceiling. It's an embedded kind of risk control to ensure that at any point in time, if the opportunity set is so great that we would want to take on additional exposure, we're also doing so in a prudent way.
All right. Thanks for clarifying that. Now, the ETF space is constantly evolving. And I mean, it seems like anybody that's had anything work, I mean, you're over $1 billion of assets under management in this fund. People are going to create their own ETFs and come after you in the space and manage futures. What sets CTA apart, like way ahead of everybody else? That's just like, this is the fund you've got to look at, even though there are other ones out there.
Yeah, well, first and foremost, we love more competition in this space because we think managed futures are a pretty nascent asset class still. So we love to see more entrants to the space. We would love the asset class to grow so that within model portfolios broadly, investors are recognizing the importance of this diversifier alongside their stocks and bonds. So with that being said, we really see ourselves as a strong complement because of our differentiated approach in the markets that we allocate to. So we intentionally excluded equity and FX futures from our remit when we launched back in 2022. And the reason for this is that we wanted to be the most capital efficient diversifier alongside your equity portion of your portfolio, which we know drives most of the overall portfolio risk. So by excluding equities, we knew that we were going to provide a low correlation to equities. We've had about a negative 0.2 correlation to the S&P 500 since inception. So that's one key attribute. Another way we differentiate ourselves is, again, that institutional model. So looking at more than just price trend to inform our daily positioning. And then the last bit I would say is the ability to rebalance on a daily basis. So that doesn't necessarily mean we're going to increase or decrease positions every single day, but as the model signals that we should, we have the ability to, and even so, within a couple hours of receiving that signal, we can act or trade on that. So I think the ability of us to be very flexible, dynamic, have an unconstrained approach in how we're taking risk, meaning we're not sector constrained, we're not doing a risk parity approach. We really look at the underlying markets that we trade in, which is North America, commodity and interest rates, as almost being a blank canvas. And so again, taking on positioning when our signals are indicating edge, and then vice versa when not. We don't want to keep our chips on the table if we don't think we'll be compensated. And then lastly, as I kind of started today's conversation, that partnership with Altus Partners based out of the UK, really their track record of almost 25 years in the hedge fund managed futures space, we think brings a lot of credibility to our strategy.
Yeah, there's a lot to love about a systematic institutional approach that is now open to pretty much everybody through your ETF. And now I wanted to ask you one last question, and there may not be a real answer to this, but with everything going on within interest rate environments and this fund being within the treasury space, and we saw what happened at Jackson Hole, and everybody's now looking at the September FOMC meeting and what rate cuts might mean and how much do they do, and everything seems to be fluctuating. How does a model or an indicator or a system kind of try to see the foresight of what interest rates might do to where it might need to do a rebalance into the treasuries?
I love that you asked this question because I feel like we're almost in the same scenario that we were around late August last year, right? So we knew the Fed was signaling they were going to start cutting rates. Markets broadly were piling into duration with the expectation that interest rates were going to rally. And many of our trend following peers were doing the same. They were taking on long positions, exposure to interest rate futures with the expectation that those positions would do quite well once rates started to drop. And the exact opposite happened after the Fed started to cut in September last year. We saw rates back up across the curve. That was actually advantageous for a strategy like CTA because we had these other indicators like the shape of the yield curve, which informed our positioning. So we weren't long interest rate futures going into last year's rate cut. We were quite short. Actually, we're in the exact same position this year. We have interest rate positioning across the curve, mainly concentrated in the front end, like the US 2-year and 5-year rates, where we, again, have a short position because the curve is inverted. And so with the expectation, again, of where rates go after potentially a September cut, TBD, we don't have a crystal ball, but we're using some of these technical signals and indicators to help inform our positioning beyond just kind of market expectations on whether the Fed might cut or not. So we'll see what happens, of course, if they cut, by how much, and if rates decide to kind of move lower in tandem or back up again like they did last year. But really interesting kind of shifts going on as it relates to interest rate policy, as it relates to tariffs. So it's made a quite eventful year for trend following broadly.
Yeah, and that's a great point. Let's go ahead and leave it there. Paisley Nardini, everybody. She is the managing director over at Simplify. This was all about CTA, which is the Simplify Managed Futures Strategy ETF. Go check it out here on Seeking Alpha. Click the follow button. Maybe add it to your watch list, your portfolio. I like to say that if it might make sense for your portfolio and what you're trying to accomplish. But can't thank you enough for the time and breaking down the strategy today. And everyone, we will see you next week in another episode of ETF Spotlight.
Thanks, Dan.